Hey, my name is Leonard Nwoteh, and I'm going to be sharing with you guys about the loan and the interest current situation. So, the federal government just increased the interest rate last week. They plan to increase the federal funds rate to 4.25 to 4.5% by the end of this year, higher than 3.25 to 3.5% projected in June. Money is now really expensive. Money is not cheap anymore to get, as opposed to maybe a year ago, 2020, 2021, where we were getting interest rate at 2%, 1 point something percent, as well as 3%. Now the banks are actually lending money at between 6 right now, 6 to 10%. So how does that affect you? It's going to be difficult to get a loan right now because the interest rates are too high. Interest rates are like 6 to 10%. It's going to affect mortgages, loans, credit card interest, and more. So for the loans and the mortgages, those of you trying to buy houses right now, when you go to buy houses, guess what? The interest rates are really high. So that is going to double or even triple your monthly payment. Sometimes maybe you were building a house and you went and get pre-approval for like 3% maybe a year ago, and now they completed the property and you went back to finalize everything, and now it's 6%, and it's going to push you away from qualifying to buy that property. And guess what? You will not be able to buy that property anymore because the interest rates are really high, and now your monthly payment has actually doubled or even tripled. So that is going to allow so many property to stay back in the market, and it's going to definitely reduce the prices of houses. And those of you getting car loans, doing auto refinancing and all that, it's going to affect you as well, because guess what? When you go to refinance or you go to get a car loan, your interest rate is going to jack up. And when the interest rate is jacked up, your car payment is going to be really high, and it's going to affect you in buying or in financing car, except that you want to buy cash. And those of you refinancing a house, it's going to be difficult because guess what? If you have a bunch of equity inside your house, it's going to be difficult to get that equity right now, because if you go to refinance that house to pull out that equity, let's say your mortgage was like 3% and you want to refinance now and the mortgage rate is like 6%. When you refinance, you're going to be paying more. Sometimes you're going to be paying double or even triple. So people are going to stay away from refinancing right now. And guess what? They're going to keep that equity inside your house, and they might lose some of that equity because the prices of the houses are gradually going down, and they might lose those equity because they cannot refinance at a higher interest rate. Also, those that had fixed 5 years fixed variable loans, it's going to affect them as well, because 5 years fixed variable loan is let's say you bought the property and got a loan 5 years ago, and they told you that, hey, after 5 years we are going to give you a low interest rate right now, and it's going to be fixed only for 5 years, and after that 5 years then it's going to switch to variable. So you're going to be paying, your interest is going to be based on the market interest rate. So right now, if yours is due right now, guess what? If you were paying like maybe $2,000, $3,000 for your mortgage, principal, taxes, and everything, and that was on a fixed rate of 2%, now your rate is variable, you might be paying double or triple. That's going to affect you as well. And those that had the variable loans, because when they give you a variable loan, they always give you at the lower interest because it's variable. Now, they are going to be working at the market rate. Your interest rate is going to increase, and now you're going to be paying more for your monthly payment than you anticipated. So that is going to definitely affect people who have variable loans on their mortgages or on anything that they are doing. Also, it's going to influence the interest on credit card. Credit card interests are going to increase because the interest rates are increasing. So if you were paying maybe 10% or 15, 17%, and if you check your statement, you're gonna be seeing like high interest rate on your credit card. So what is the Fed trying to do? So they are trying to pull out money from the economy. They're trying to combat inflation. So they are saying that there's a lot of inflation, there are high prices on everything, so they are trying to stop inflation, and they're gonna keep increasing this rate until inflation is down before they are going to stop. What is inflation? Inflation is a rising of prices of goods and services, and which can translate as the declining of the purchasing power. So the government is trying to actually bring that down, get rid of inflation so that the economy can come back to normal. So we are going to be experiencing higher interest rate throughout the end of this year, and we are going to see what is going on. So stay tuned, and I'm going to update you guys on the market situation as we move forward. Let's roll. Make sure you smash that like button. Subscribe to this channel for more real estate video.